Silver miners are massively undervalued at these levels, according to my guest today, Steve Penny, and he stresses that with silver in the $50 to $60 range, many of these silver producers are printing cash and being completely mispriced by the market at large. Eventually, Steve expects that paradigm to change, and when it does, the miners could absolutely skyrocket. Steve also dives into gold and gold miners and reveals why he believes uranium is perhaps one of the best bets to make right now in the commodities sector. All of this and much more ahead. And guys, I recently held the Commodity Culture Boot Camp, the very first one. It was an amazing session. We have the replay still available at join.jesseday.ca. The link is in the description. And now, Steve Penny. Steve Penny, it is great to have you back on Commodity Culture. I want to kick things off with discussing the silver market and kind of through that getting into the whole pattern that's been emerging since the Iran war started when it comes to precious metals. We've seen both silver and gold falling when it looks like the conflict is on and moving back up once it seems like peace could be on the table. Now, obviously, this has been far more pronounced for silver being a more volatile asset. It looks like war is full on and back on the table, and this conflict could drag on for a lot longer than I think many people are anticipating. Before we talk about where you see silver headed specifically, can you share your thoughts on how the war has been affecting the market and how you see that situation playing out?
Sure, absolutely. And thank you so much for having me back on. The last couple times we've talked have been key inflection points in the market. So hopefully we're speaking at another kind of key inflection point near the bottom. I remember we spoke as silver was breaking through $54 the day after Thanksgiving, then in early February, right after that peak. And now here we are back down, in the 50s, low 60s in silver. So hopefully we're finding a bottom here. But yeah, thanks for having me back. And to answer your question, I'm no geopolitical analyst, but I have been studying geopolitics long enough to know that we've been in basically the United States anyway, kind of a perpetual state of war since 9/11, since 2011, when supposedly 19 Saudi Arabian hijackers flew a plane into the World Trade Center, and then we go into Afghanistan, and followed by Libya, followed by Syria, followed by Iraq. And what tends to happen with these geopolitical conflicts is the markets are very volatile at the start of them, and then the market kind of tends to become desensitized to the headlines. And I think we're kind of approaching that point with Iran. But the key thing that the market cares about, now as a human being, I care more about the human suffering and all of the casualties and the horrific things that are associated with war. But what the market cares about is whether the strait is open or not. I think the market is less concerned about the bombs flying back and forth, but more on whether that strait is open. And what that has a direct correlation over to Fed policy, because if the Strait of Hormuz is closed or is, there's the rising threat of it staying closed for longer or getting closed again, back and forth if it's closed or open. But, the Fed's hawkish posture right now is directly correlated to the perception of the future of openness of the Strait of Hormuz. So I think that's really what's weighing on the market right now. And I think, that ties right over to the new Fed chair, Warsh, who's kind of talking tough because inflation has ramped up. And that's obviously weighing on the metals. So I think that's kind of how the geopolitics fits into the precious metals market right now.
Very interesting. Now, it looks like the strait has been closed again, and it looks like the war is going to be on for an extended period of time. I mean, we've seen some pretty serious escalations when it comes to the U.S. attacking a bridge that's being used for trade with both China and Russia. Now, I want to stick to the metals here, and perhaps we'll turn to the fact that they're generally seen as a safe haven asset. It hasn't really played out that way so far for people who are expecting the metals to rise in the face of continued and rising global conflict, and yet here we are. Do you think that pattern will shift, the one I was discussing earlier about the metals falling when it looked like that the war was on? Do you think we could see that reverse going forward, assuming things continue to ramp up?
I think so at some point. Ultimately, the fundamentals prevail. That's why I like to say fundamentals tell me what to buy, technicals tell me when to buy and when to sell. But yeah, the long-term fundamentals, as your listeners know, for gold and silver is monetary debasement and our biggest global debt binge in all of human history. And at the end of the day, these governments are going to be forced to debase the currency on a scale that we've never seen before. And that's the primary tailwind for the metals. Now, does that mean they can't fall more based on headlines? Sure. I mean, if the market perceives Fed hawkishness with more restrictions on the Strait of Hormuz, the precious metals are probably going to dip further. But over the long term, I think the macro fundamentals will ultimately assert themselves. So, I'm in a buy the dip mode. I'm not in any kind of sell the rally mode or any kind of mindset of that this is the end of the bull market. Although downside risk remains, I think there's a higher probability outcome that we've seen the lows, but there's still, maybe a 20-30% chance that we get one last flush lower down to the low 50s in silver, down 3,600 in gold. So I'm focusing on strategy rather than predictions. I'm mentally prepared for lower prices, but even though I think the most likely outcome is that we've seen the lows.
Well, I want to talk about your strategy for silver. First, we'll talk about the physical metal, and then we'll get into the miners a little bit later. You're unique compared to a lot of guests I have on in that you have a long-term game plan and you also make short-term trades as well. So I'm wondering if you could talk about your current mindset when it comes to investing in silver, whether that's physical or perhaps trading certain paper alternatives like PSLV, et cetera. What's your game plan right now when it comes to silver itself?
Yeah, and I do. I have a long-term investing bucket. I've got my physical metal that I'm not touching for a very long time. In fact, some of it I'm just going to keep as a generational insurance policy. And then with the mining stocks, I've got a longer-term bucket, and then I've got a kind of a shorter-term trading bucket. So where my mindset is right now, and I don't want to sound like I'm less bullish than I am, but I feel like the easy money has been made in silver, going from, when you can buy silver at sub $30, I thought that was kind of the biggest no-brainer around. When it ran up to 120, we took major profits right near that peak. And, I didn't know it was going to roll over to this extent. So I don't want to sound like I'm trying to be arrogant or anything, but we did. There was maybe a little bit of luck involved. We sold 75% of our speculative silver positions, within a day or two of that peak. So my point is, I still have adequate exposure. I've still got plenty of exposure, but now I'm taking those kind of life-changing profits and using some other strategies. I don't want to necessarily put it all right back into precious metals. I think when you hit the big home run, it makes sense to kind of diversify. So what my mindset now is I'm being more selective. I'm being more patient. I've got my position size where, hey, I'm content if it just runs away to the upside right here, right now, which I don't expect. But if that happens, hey, I've got enough of a seat at the table. But I'm not so overweight like I used to be, where if it drops 20-30%, it's going to have a bigger effect on me. So I'm nibbling on dips. And another strategy I'm using, which is kind of unique, I hadn't heard about this in the precious metals circle very often, but I'm using options. And I'm not some big fancy options trader, but I'm basically selling put options. I'm selling puts. I just did one yesterday, and I'll just tell you the name of the ticker on Royal Gold. So I got paid $325 by saying, hey, you know what? I will obligate myself to buy Royal Gold about 20% lower than the current price. I could get that cash right now. And if price closes below, that strike price, about 20% lower in about a month from now, well, I get assigned the shares at a lower price. If not, I just keep that money. So that's an accumulation strategy I'm using now. I'm selling put options at a lower strike price. So I'm getting paid to potentially buy high quality companies at a lower price. And if I don't get filled on it, well, I'm just collecting the income. So that's kind of how I'm approaching it right now.
When it comes to evaluating the silver mining sector as a whole, taking aside your recent experience, let's say from the mindset of somebody who's approaching the sector and doesn't have much of a weighting when it comes to silver miners, do you see it as undervalued at present? Because even the biggest miners, Pan American Silver down around 20% year to date, many of the other ones the same, some of the developers even more so. Do you think this could be a buying opportunity? Obviously, we don't give investment advice here, but I'm just asking you to look at it through the lens of someone who's approaching the silver space right now. Do you think it's undervalued? The miners specifically.
I do, absolutely. They're printing cash at these prices. Even after the big dip, we're still, in the grand scheme of things, if we told you going back, let's say a year ago, that we're going to be at high 50s, low 60s in silver, most people would be ecstatic at that prospect. So the mining stocks are highly, highly profitable right now, and I don't think they're pricing in the profits. I think, in other words, I think the market is pricing in lower silver prices. So even if silver prices just hang out, if they can just maintain where they're at now, around in the 50s, and gold around the $3,500 to $4,000 level, these companies are going to continue to print profits. and I think they're going to be revalued higher. But when I look at the whole sector as a whole, because you asked about silver miners specifically, silver miners are the most undervalued component of the whole sector, the whole precious metals complex, I should say, to be more specific. I run ratio charts of SIL, SILJ, GDX, silver, gold, all the different components. And right now, SILJ, the kind of the smaller cap silver names, are the most undervalued. Another interesting sector that I'm subcomponent of the precious metals sector I'm looking at now is the top tier royalty and streaming plays, because like a mining stock's margins, a pure play mining company, when we drop from say $5,000 gold to $4,000 gold, that's a bigger impact on their margins than a royalty and streaming company with that same drop in price. In other words, their margins haven't been compressed as much, but they've been treated just like the large cap mining stocks. So the big names like Wheaton Precious Metals, Royal Gold are really interesting to me right now as well.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Let's turn to gold, because the tailwinds behind the metal appear to be stronger than ever. We've, of course, seen a similar pattern play out, as I was alluding to when the war began, as with silver. We're way down from all-time highs in January this year. I believe that was late January, early February, somewhere around there. How do you see the gold market playing out for the rest of the year?
I think in one word, the answer would be range bound, just like in silver. I think the lower end of the range is probably 3,500 at the extreme low end. Not sure we get there, but I think that's probably within the spectrum of plausible short-term outcomes. I think 3,500 is about the low end, but I'm not expecting some huge rally to new highs anytime soon either. I think 3,500 to 5,000. I know it's a pretty wide range, but I think that's probably where we're going to be for a while, maybe into 2027. Similar for silver, I think we're going to be range bound for a while. The good news is that, like in the 1970s bull market, I call it our 1979 moment, where silver went up 8x in 12 months. That moment still awaits. I think it's just a little bit further down the road than many people think, and we're told, back in January, we're going to $300 silver this year. I think these things are going to come, but it's going to take longer than many people think. It's been said a precious metals bull market will either wear you out or scare you out. So I think we're kind of in the scare you out phase now, and then next comes kind of the wear you out, where it just gets boring. A solid basis build where the people have the deep fundamental conviction gradually accumulate, who aren't the strong hands, and kind of some of the Johnny-come-latelys kind of get shaken loose. So I think I'm getting a little bit long-winded, but I think we're going to be range-bound longer than many people think, perhaps into next year, if not even a little bit further. But the big fireworks, I think that the move we saw last year and into January was the warm-up. The big move still awaits us. I think it's just going to be a little bit further out than many people think.
And do you think that big move will be partially driven by more retail investor participation in the sector? Because right now, everybody seems to still be attracted to the shiny object. We saw the SpaceX IPO. Cathie Wood from ARK Invest has just put a bunch of money into this thing. I mean, anybody who listens to Cathie Wood, I don't know what you're thinking, but the point I want to make is that this is a company that's experiencing massive losses, trading at 100 times price to sales. And, it seems like everybody from retail to institutions were piling in. We're seeing continued strength, maybe not strength, but at least, the broad market remaining at these ultra high valuations in the face of a war that's broken out that threatens to get more serious. Do you think it's because investor attention is on these, IPOs, AI, and the big tech companies? And do you think it will take that market, having a serious correction to then bring more people into hard assets and things like precious metals?
Yeah, it's a really, really good question, really good thought experiment. I'm not sure that we need like a general equities crash or even, a sharp pullback in order to rotate capital into the precious metals, although I do think it would help. But on a kind of a deflationary impulse like that, where the broad markets come down, I think silver and gold would get hit initially. But then as money starts to come back into the market, I think it would come back into silver and gold as opposed to going back into some of these more bubble kind of sectors and stocks. So I think on net, yeah, some kind of any cracks in these bubble sectors would be a net benefit to precious metals for sure. And with the retail participation, yeah, I think at the end of this, when this bull market really gets going, when we have the big move, it's going to be the retail uh, people who are just piling in. I don't think we really had that to much of an extent last time. I'll be honest, I sold just a little bit of physical silver. That was the first time I ever really sold any physical metal. During that last week of that run up to 120, and I was down at the shop, and I called them. I called around to all the different shops, seeing if they'll match, the best prices online. And there was only one place in town that would even buy the silver. Four out of five said, nope, we're not even looking to get it right now because everyone and their brother was down there trying to sell silver. So my point is, I think the retail public on this last one was selling. They're scrounging up any silver they had. The place was just packed with people selling silver. So I think on the big move, the retail public's going to be down there buying into a price rise. So I think that all that to say, I think the big move still awaits.
And gold miners, obviously, I think a pretty similar situation to silver miners in terms of valuations. Would you agree there that they're also looking quite undervalued? I want to bring one of my own investments in because I purchased Agnico Eagle shortly before their last earnings report, thinking, hey, this is great. I mean, I should have known. I just watched Newmont report earnings and seen their stock fall. So I kind of knew, okay, but ultimately I'm not trying to time the market. I just believe over the next 5+ years, Agnico Eagle is going, as one of the biggest and best gold producers on the planet, is going to return a solid amount. I'm not expecting a 10x or anything like that, but I look at it as a solid play if I believe the gold price is going to be upright of the screen over the course of time. Now, since, of course, they reported earnings, and of course, they were record earnings, and of course, the stock fell. Now I'm down some 20% on this thing. I'm not asking you to comment specifically on Agnico, but rather using it as a proxy of what's happening across the sector. Producers raking in cash and getting sold off. What's your take on that? Do you think we could see further downside ahead? Is this as much of a buying opportunity as the silver miners in your view?
Yeah, I think so. Maybe not quite as good of a value proposition as the silver miners, but not everyone has to. Yeah, the silver miners are a better value proposition right now, but they're also more volatile and there's a little bit more downside risk. I love Agnico Eagle. It's my favorite gold mining stock for sure. I call it a swan, sleep well at night stock. To me, it's the best run gold miner in the world. And I think just the market is it's pricing in lower gold prices ahead, which, yes, some downside risk remains, but I think the downside risk is small relative to the upside potential. So you mentioned, having a 3 to 5 year time horizon, I think you said. For those kind of people who have that longer time horizon, I think this is a great value proposition. So strategy is greater than predictions. And for those looking to accumulate, I don't want to say advice because I'm not giving advice, but something to consider would be to maybe, you can tranche in, scale in. So I think these are great levels to scale in right here, right now, but keep some capital aside so that when you get those 20% pullbacks, it's a welcome opportunity for you to buy more. I like to say, always keep your position sized properly so that you're happy if you get a 30-40% rip higher in your stock or sector, but also keep enough cash available that if you get a 30% pullback, you're happy as well. That allows you to sleep well at night, to manage the emotions of these wild sectors. But yeah, to answer your question directly, yes, I think gold miners are very undervalued. They're just printing cash at these levels. Even if price drops a little bit more on gold, they're still going to have record profits. And the lower oil prices now is certainly going to help as well, because oil is the biggest input cost. So I think quality names like Agnico are good value propositions right here, right now.
Let's talk about my favorite metal of them all, which is uranium. I wonder what your thoughts are right now on uranium and the uranium miners. It's been an extraordinarily volatile ride. We've round tripped on a lot of these equities so far year to date. I don't know if there's any sector as volatile as uranium equity. Sometimes you look at your watch list or your portfolio and it's up and down double-digit percentages in single days. What are your thoughts on the sector? Are you bullish at these levels? And how do you think the best way is to stomach and handle that sort of wild volatility in the sector from maybe a psychological and practical perspective as well?
Sure, yeah. So uranium, in one word, I think it's undervalued. And I've been telling my members, silver chartists, that I think uranium is the best value proposition of our focus sectors. We focus on silver, uranium, gold, platinum, and energy. And I think I'm the most bullish on uranium right now from a risk returns basis. When I look at a ratio chart of uranium versus gold, uranium, we just came out of a period where uranium had underperformed gold for, I want to say, 15 consecutive months. I'm doing that from memory, but it was a record. And uranium is now extremely cheap when priced in gold. And I think, as bullish as I am on gold, I think uranium is going to outperform gold by a pretty wide margin. And on that ratio chart, we see, it just beginning to kind of form a brand new uptrend when priced in gold. So very bullish on uranium. For better or worse, it's currently highly correlated to the AI space. And I've always viewed kind of the demand for these AI data centers needing electricity and, the steer towards nuclear as like an upside kicker, not a thesis maker. But I think because there's a little bit of a weakness in this AI narrative right now, it's kind of uranium's getting kind of thrown out with throwing the baby out with the bathwater, whatever that phrase means. But but the fundamentals haven't changed. We don't need those AI data centers and that demand for uranium to be headed towards a structural supply deficit. So I think we need higher prices ahead in uranium. And to me, that's my favorite sector to be accumulating right now. And you said how to manage risk. Well, the same comments apply that I made about gold and silver before, having your position size properly so that you're happy if you get a 30% pullback or a 30% rise. And I mentioned selling cash secured puts. I'm doing that exact same thing on high quality names in the uranium sector. I'm saying, hey, prices down here, it's already fallen by 30, 40, 50%. I'll buy 20% lower but over the next month, but you got to pay me to obligate myself to do that. So I'm just collecting, several $100 every time I do that. And you can just do that month after month after month. And eventually the price will drop below that strike price and you get assigned the shares. If not, you just keep the cash flow coming in. So that's a really unique way to a really unique accumulation strategy. And it de-risks because, you're making cash and, if you do get assigned the shares, if you do buy, it's at a lower price. So I think it's a win-win scenario for people looking to accumulate. It's just something to consider.
Yeah, that's a very interesting approach. How do you separate the wheat from the chaff in the uranium sector? Because there's so few producing companies. You basically have Cameco, Kazatomprom, and Orano, and Rio Tinto, obviously, a multi-commodity company. But in terms of pure play uranium producers, that's kind of about it. And then you can go down the chain, and yeah, there's some developers who have started to produce, but it's in really, really small quantities, nothing at commercial scale yet. So how do you then hone in on the developers that could potentially, have that solid path towards production? Because we know mining is such a tough business. Do you stick to those big producers, or do you venture into the developers and even the explorers? And if so, how do you kind of tell which ones have the best chance of eventually producing or re-rating up ahead?
Yeah, great question. And I'll just be totally transparent up front that I'm not a stock picker. And everyone has to have an edge in the market. And it's important to know what your edge is. And my edge is timing the sector. We've done pretty good at that, timing the peaks and valleys of the sectors we focus on. I'm not you can show me drill results and NI 43101s and all that. I don't get into the weeds on that stuff. So I tend to just stick to the kind of the larger cap names, the Camecos, the UECs, and the ETFs. If I could own just one ticker, it would be URNM, the Uranium Miners ETF, because you get a basket of just quality names there, and that allows me to get that diversification while just focusing on what I'm good at is timing the sector. Now, for those listening out there, maybe you are one who can get in the weeds and try and pick stocks and outperform the ETF. Great. That's just not my thing. So I try and focus on what I'm good at and focus on the quality liquid names along with the ETFs and just timing those things and selling puts. And when we get extreme overbought against resistance, I take profits without emotion. And same thing when we get extreme oversold against support, I scale in. So yeah, I don't mess with the explorers and developers.
No, I love that approach. That's very similar to my own approach. Even if I do speculate on individual names, I always make sure I have an ETF, big royalty streamer, best of the best producers as my anchor positions, and then position size accordingly using smaller amounts of capital to speculate on developers. I don't get into the exploration space at all. But you mentioned energy. I really want to get into that, particularly as it's quite a timely topic with the closure of the Strait of Hormuz. I'm very bullish on the sector. I accumulated a fairly large oil and gas position prior to the Strait of Hormuz debacle kicking off and the war starting. Um, but at this point, I'm hesitant when people ask me about investing in the energy space simply because you're in the middle of this crazy geopolitical event. A single tweet by the president can send oil markets moving one way or the other, and nobody knows how this whole thing's going to play out. So my strategy here as an investor in the energy space is I'm sitting on the sidelines and seeing how this whole thing's going to play out. Is that your approach as well, or do you see some opportunities here being presented by this whole war scenario?
Yeah, I'm playing it very similar to you, and I agree with your comments 100%. It is look, going back to everyone needs an edge in the markets. To me, it's even more difficult to have an edge in the energy sectors because there's just so many geopolitical cross currents, and trying to really have information asymmetry is almost impossible because you're competing against the big oil traders and Wall Street. They've got satellite images. They're seeing every time a ship crosses the strait, and they know more than we do. So trying to compete with information is very difficult. So instead, I've got if-then statements. My if-then statements, broadly speaking, are if we rally up towards the $120 level, the previous high from February or March, I'm going to trim profits or sell covered call options. If we dip down to the 60s, like we were just last week, I'm accumulating. So that's kind of my plan right now. And it's interesting, leading up to this Iran conflict, I've been in the peak cheap oil camp and thinking that, hey, we've got all the easy resources, and, we're going to have growing demand and diminished supply coming forward. But I have to admit, I am still leaning in that direction. But there's some really smart people out there who I respect, like Doomberg for one, and there's a couple others who they do make pretty compelling cases that the world has plenty of oil, and it's more geopolitical constraints than physical constraints to getting that oil out of the ground. I'm not on board with that, but it's really interesting that you always got to look at the opposing viewpoints from a long-term perspective. And Doomberg makes the point, like, if the strait being closed for however long it was only got oil to 120, like, what is it going to take? Really, that was like the perfect storm for 200 plus oil. And if we didn't see 200 plus oil, what is it going to take? And I think that those are valid questions that I don't have answers for. But like you, I got positioned in the oil space last year before anything with Iran. So now I'm just managing those positions. And any rallies up towards 120, I'm trimming profits, and then dips down towards the mid 60s like we were just at, I'm nibbling. So that's my plan and my strategy and general thoughts.
Yeah, interesting and great comments about listening to opposing viewpoints. I think that's very important. It's tough on this show because if I get somebody who's bearish commodities, Mike McClone, for example, nobody watches, and the guy just gets destroyed in the comments, right? So it's tough on this show to present those who have a competing, especially if they don't want to buy gold or silver. They don't think that there's a bull case to be made for gold and silver. But I've had those same conversations with Doomberg and a few other people as well on the oil market. So always good to consider the other side's opinions. Aside from everything we've discussed today, are there any other areas of the market, commodities or otherwise, that look attractive to you right now?
Yeah, there's some that I'm watching and nibbling on. So a few years ago, rewind to the depths of COVID, and I was employed at the airline still, and I had silver charters, but it was really new, so it seemed very fragile to me. And I remember thinking there were certain things I just wasn't going to do to my body, and I thought I might lose my job back then. And where I'm going with this is I didn't really have many multiple streams of income, and I got a family to provide for. So what I started thinking about is truly passive income. A lot of people talk about real estate. Yeah, that's a lot of work to manage real estate properties. But to me, truly passive income can come from dividend stocks and real estate investment trusts when they're undervalued, when they're priced properly. And I've been building a dividend portfolio for passive income. And these are super boring names. And there's plenty of high quality stocks out there. Like Chevron, for example, has increased its dividend for 38, I believe, consecutive years. So a lot of things have happened over the last 38 years. But they've rewarded shareholders with a pay raise in the form of an increased dividend through all of that every single year. And what I like about that style of investing is I don't care about the share price, because if I have shares of that stock, I'm never going to sell it. It's kind of like people who maybe have a rental property that they're never going to sell. They're going to give it to their kids and their kids after that. Well, who cares about the price of the rental property? Well, in the same way with these dividend stocks, I don't care about the share price because I'm not selling it. What I care about is the company's ability to continue to increase its dividend at a rate that outpaces inflation so that I have that backup income stream. Now, I don't need that income stream now, so I just reinvest those dividends back into these high quality stocks. And if the day ever comes where I need that income, I just turn the reinvestment off, and now I can have that income stream. Now, it takes a lot to fully replace your income, but if you lost your job and now you got $1,000, $2,000 a month, that can really help. So high quality dividend stocks are what I'm building a portfolio of as well. Boring names, like super boring ones, Procter & Gamble, Clorox company. I kind of laugh whenever I say that because every once in a while someone signs up for Silver Chartist and I added shares of Clorox. They're like, what is this? Clorox. Well, it was like it had the highest dividend since 1980. It's bounced since, but that dividend was like 5.5%, 6%. And they've increased that dividend for almost 50 years. So, I'm not going overweight with that, but it's another thing I'm doing as opposed to just being all in on silver. And I'm taking some of those profits we made back earlier this year and just building some other kind of strategies out there. So a little bit of a long-winded answer, but that's what I'm doing.
Great. No, that's some great insights. And I agree that it's good to move into other areas and get that income stream. Cash on hand. I'm wondering how much you're allocated in cash, how important you think it is right now to have dry powder on the sidelines, particularly, with these levels of overvaluation in the broad market. If we do see a severe correction, as many are calling for, obviously that's going to bring down a lot of the quality names and many names in the commodity space along with it. Do you think at this point that bears having an even larger position in cash than one normally would? Or are you more of, I think it was Peter Lynch who said that more people lose money waiting for a correction than in the actual correction itself?
Yeah, it's totally true. So I'll try and keep it a concise answer, but I am actively building cash. We live in a big boom bust cycle. There is going to be a bust. Timing it is kind of a fool's errand, but it's coming. There's going to be a big deflationary impulse. And side note, I think it'll be the Fed's response to the next big deflationary impulse that is the catalyst to send our metals prices on those huge, huge moves that we're all expecting, 300 plus silver, 10,000 plus gold. It'll be the Fed's response to that next big crisis. So I want to have a pile of cash whenever that crisis hits. I'm not smart enough to know when it's going to happen, but right now I'm sitting at about 20% cash. So to be real detailed, I've got my emergency fund that everyone should have. That's just basic personal finance. I'm not counting that. So I have my emergency fund, and then I'm calling it an opportunity fund of capital. And I just put mine in SGOV. It's a short-term T-bill ETF. You get about a 4% yield. SGOV is the ticker. I'm not endorsing that, but that's just where I park my cash. So it's earning some capital and earning some interest. And I'm building that up. And I want to get that up towards about half of my portfolio or a little bit more by the time that deflationary impulse hits. So what I'm doing is I also short-term trade. So any of my profits, I'm just cycling into that opportunity fund capital. So that's how I'm handling it. And I think it does make sense for sure, especially in this environment where, this is probably the most fragile the overall markets have ever been in the last 100 years. So there's going to be an accident at some point, and that'll be a benefit to you if you have a big pile of cash. So, I think about how the fortunes were made in like the Great Depression, the Rockefellers, when they went around, bought up half of New York City for pennies on the dollar. So it's rare that person who has cash available when the fire sales come.
Yeah, and the courage to deploy it. Tell us about Silver Chartist. I'm going to put a link in the description below for people who want to check it out. What is it you do over there, and why should people consider signing up?
Sure, yeah. Silverchartist.com, fully transparent, over-the-shoulder service, real-time alerts. I show members exactly what I'm doing, so they see my exact portfolio, including, the dividend stuff, which, they sign up and see what's Clorox doing in there. Well, they get an over-the-shoulder look, and I don't claim to be perfect. They see my mistakes as well, and we all learn from each other, and the goal is to help navigate these markets alongside one another. We also have that add-on service where we sell put options and we sell call options to create consistent income while we wait, because I think it could be a while. I'm as bullish as you could possibly be over the long term, but I think it's going to be a little bit longer than most people think. And, if we break out sooner than expected, I will adjust on a dime, but I think it's going to be a while. So in the meantime, I'm making consistent income by selling options. Most people want to buy them, because that's where all the excitement is. But the vast majority of option buyers lose money. So we take the other side and we just sell them, and hit consistent singles. So far this year, we're at over a 90% accuracy rate on our trades. And we just do this day in and day out, making consistent income while we wait. So silvercharts.com, thank you so much for the opportunity to say all that. And thanks for having me on.
Of course. As I mentioned, the link will be in the description. Always enjoy our chat, Steve, and looking forward to the next time we can talk.
You bet. Thanks so much, Jesse.
Thank you for joining us today. This episode is brought to you by ARC Silver, Gold, Osmium. They have some great prices on precious metals, bullion products. You can see some of them on your screen right now. These are subject to change, and well supplies last, so reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and be sure to watch the replay of the recent Commodity Culture Boot Camp. I opened my portfolio A to Z, dove into all the companies I own, why I own them, what I've been buying, what I've been selling, got amazing feedback across the board. We had a great Q&A as well. You can access the replay at join.jesseday.ca. The link is in the description, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.